Hello and welcome to our mid-year outlook 2025, which this year we've titled Living in a Land of Confusion. Now we're going to be doing two podcasts. One will be focusing on the macroeconomics of the year and into the year end. And we'll be doing a second podcast for those who are really interested in what this means for the financial markets, whether that be equities, bonds, credit, or anything in between. But today we're going to kick off with the macro side of things, and it really comes down to all the T's. We've got Trump, we've got tariffs, and we're going to start with Tom Levy to speak a little bit about the United States. Tom, let's speak about what's happened in the first 6 months. We have a new president who's been energized to come in to office. He's certainly been living up to his election pledges, and he must be making your life very easy. He even tells you when to buy equities. Has it been that easy?
Absolutely, yeah. No, I mean, now that you mention it, he sends out the tweets, or well, it's not a tweet, it's a social truth. But you're right. Obviously, things have started quite unpredictably. A lot of I wouldn't call it chaos, but
oh, come on, call it chaos, or at least erratic chaos.
Erratic chaos, absolutely. And I don't think a lot has changed since then. I mean, what we do now know that our initial assumption of Trump being mostly transactional and not maybe a fundamentalist seems to pan out. So just coming back to your example about tariffs, we did expect, I think most people did expect tariffs to be implemented, but then came Liberation Day with this really, let's call it outrageously high levels of tariffs, which triggered a bear market in the equity market, which raised recession fears and growth worries around the globe. Just for him then to eventually track back and postpone the tariffs. The same story when he went into a tit-for-tat duel with China, where he said, look, I'm willing to really lift tariffs to 145%, just to then also postpone these tariffs for 90 days. And since then, we have seen much more softer tones and much more dovish stance. And I think that made my life definitely a bit easier over the past 2 months.
But tell me, I mean, what do you really think President Trump wants from these tariffs? Is it really to have a zero or close to zero trade deficit, or is this a much bigger bargaining lever that he's using for other nations?
No, look, in the end, I do think he really doesn't like trade deficits. I mean, he made that clear all over his career, not only since he became president, that started well before that. And probably it is coming from his background. He's a deal maker. He does think that it's not a win-win situation. It's a zero-sum game. So if there's a deficit, somebody has to lose. I think that's really what he thinks. So he wants to reduce these trade deficits. He wants manufacturing to come back to the US. He wants things and stuff and goods to be produced in the US again, whether that makes sense from an economic point of view or not. But I truly think that's his intention. Whether he wants to aim for zero trade deficits, maybe initially that was a desire or a wish, but probably he gave that up because he must have realized that's not realistic in the current world. But still, I do think that he wants to have what he considers to be a fairer deal with regard to trade, with regard to tariffs, with regard to taxes.
But tell me this, I mean, that sounds sensible in many ways, and you could argue that we had become too extreme with some of the deficits that we've seen. But tell me, I mean, I always say that tariffs are a tax, and they're a tax effectively on your own people, because we see spikes in terms of the revenue coming from tariffs, but it's not the Chinese or the Europeans that are paying that. It's the domestic population, whether that be consumers or companies. But what do tariffs mean from growth in terms of your own growth figures for this year? And perhaps tied to that, what does it mean for inflation in the United States at a time where we've just come back from very high levels of inflation?
I mean, first of all, as you say, tariffs are basically a tax. Now, it remains to be seen who eventually pays that tax. That also has a lot to do with how you can substitute for goods or services, how elastic demand is. So is it easy, as Trump made example himself with the dolls? Do you really need $20 or are $5 enough? Now, it really depends. And why is that important? Because if we talk about goods or services that are highly inelastic, meaning people need them or they absolutely want then yes, probably in the end, prices will go up close to the amount of the tariffs, which means the consumers is going to pay. If the demand is very elastic, people can say, no, I don't need $20. I mean, 5 are enough. Then obviously nobody will eventually pay the tariffs because people will just shift demand to other things, which means then it will be the exporter in the foreign country who kind of takes the cost, not the tariffs, but has fewer sales and less demand for its products. So yes, it is a tariff, and probably the truth is somewhere in between. As you can see already now, we look at consumer spending, we look at business spending in the US, and it hasn't, I mean, it did slow down indeed, but it hasn't it didn't fall off a cliff. So somebody is paying the tariffs, and that will mostly be the US consumers and
inflation,
businesses.
is that really going to prevent the Fed cutting rates this year, or do you think they'll look through any kind of short-term move up in price?
Well, look, I mean, they're quite reluctant currently. We have seen that during the latest call and after the meeting, because they don't know. Nobody knows for sure. Of course, if you simply add a tariff to a price, it will be inflationary because the price will go up by that amount. But as I just said, if demand slows, if there's less growth, that will have the contrary impact on tariffs. So the Fed wants to see which effect is strong. I still think tariffs are mostly a headwind to growth rather than a long-term issue for inflation. Now, the only problem, maybe not the only, but a key problem for the Fed is we do come from a period where they have consistently not reached their target with inflation being too high. So now they're kind of burnt, and they're maybe a bit overcautious not to let it happen again, which is why I think they are reluctant. Also, to answer the question, I don't think the main problem with tariffs is inflation. It's more about growth.
So come on, Tom, chips on the table. How many cuts between now and year end?
2 more cuts in the second half of this year.
Great. I hope we've got that on film, because we'll come back to that later on. Tom, very good setting the scene here, but let me turn, Charlotte, to you and the global environment that we're in, because of course this isn't just about the US, this is having a big impact in terms of global growth, global inflation. How do you interpret kind of what Tom has been saying? What does this mean for global economies? What does this mean for global trade?
Yeah, I mean, from a global point of view, trade is not a zero-sum game. That's very clear. Trade allows all countries to benefit and to prosper from exchanging ideas, goods, services with each other. And human beings have always done it. We've always been trading. It's the fact that small countries, most of the countries in the world, are not able themselves to produce goods that we need in our kind of highly complicated and technically very advanced world. So you need to trade. That's the starting point for everything. Now, if you want to reduce your trade deficits, I would argue that there are better ways to do it than to put high tariffs on some of your key trading partners. I think where we ended up now on tariffs, so the initial tariffs around Liberation Day tariffs, they were punitive for the global economy. It was very clear if those kind of tariffs came into place, which was basically an embargo between the US and China on
that
trade.
That was going to be recessionary, right?
That was going to be recessionary, and maybe even worse than recessionary, because literally these supply chains have taken decades to build up, and you can't just rip them apart. And there are many other countries that are part of that. I will speak later on about the ASEAN and how that feeds into that. So that was the starting point. Now where we have landed currently, these tariffs should be manageable through a combination of a bit of inflation pressures in the US, maybe a bit of margin hits by US companies and importers, and also downward price pressures in supply chain. But also weakness in demand more broadly. And I think this is what we're seeing. Outside of the US, we are seeing kind of disinflationary pressures, partly, well, very much capturing the lack of pricing power that these countries now have, that are exporting into the US, where the importers are basically pushing those tariffs back in the supply chain. From a global point of view, that's a positive thing on the margin, because we are coming from a place where inflation was running too high for too long. So a bit of more deflation in the system is not necessarily a bad thing. In terms of the growth outlook, it's weaker compared to where we were in the beginning of the year. Partly reflecting the US kind of headwinds, partly what's going on in China and Europe as well.
But could this make the global economy perhaps, dare I say it, more robust? Because does it take away some of the imbalances? Does it encourage others to do more? How do you see that?
There are some countries globally that, of course, have had a persistent history of very weak demand, basically benefiting from the rest of the world buying their stuff and basically growing in line with the global economy. And clearly, that's not a sustainable kind of economic policy to just benefit from demand elsewhere. So the fact that we're seeing more domestic spending and efforts to kind of increase that domestic piece to make growth more resilient, I think that's a good thing. Yes, I think it's the way it's come through that is not a good thing. And maybe on my last point is just the level of uncertainty. Uncertainty is bad for economic activity. There's an option value to waiting. Why do something now if you can just wait and see where you're coming out?
And from my side, I mean, it takes years for companies to set up plant and equipment. And if you don't know what policy is going to be next week, never mind in 3 years' time, why would you commit today?
Yeah.
But maybe one last question for now. Does this mark the end of globalization as we know it?
Mark the end of globalization? No, I would clearly, strongly say no, it doesn't. As I said, businesses need each other, countries need each other. I think outside of the US, we have seen very strong kind of focus on making sure that companies can continue to trade. So I think definitely trade will be with us. I think what we've seen over the past few years, really following the COVID period, is how resilient trade has been. And for me, that's kind of confirms that trade is a necessary ingredient in the world we're living right now. But it might look different. We've seen a bit of hyper-globalization over the past. We had big countries, China and others, being pulled into the global trade system. That is probably going to be less of a push factor going forward. So a bit less of growth rates, but clearly trade is here to stay. There is no doubt about it.
And maybe one last one to you, Tom. We're on the brink, I think, of having the big, beautiful bill passed, or triple B bill. I hope it's not the credit rating on it, but we're very close, it seems, to getting that through. What does that mean for the second half of this year? Because in the first half, it was all about tariffs. It was all about potential embargoes. Now there seems to be hope about potential extensions for taxes, even tax cuts coming through, and perhaps even lighter regulation.
I mean, look, first, the point you implicitly made is this time around, compared to Trump's first term, is that he went about it the opposite way. He basically came with the tariffs first and then the proposed tax cuts, which are not through yet, but which are likely to come through. Now, we should also not forget that the biggest part about the bill is not to let the initial tax cuts run out. So, I mean, it's not so much an additional stimulus, but it's just keeping the stimulus that we have and avoiding a massive tax cliff or a fiscal cliff. But on top of that, as you mentioned, there will be some additional tax incentives. You have a few measures like no tax on tips, or maybe also in the corporate sector, some beneficials. So yes, I do expect some stimulative impact coming from this bill, which is likely to be published or passed in the coming days. However, I wouldn't expect too much of that. It's really just avoiding a major drag on growth rather than adding much more stimulus. And we should not forget, we'll talk about that in the other podcast when we talk about markets, it also comes at a price. I mean, investors do get a bit worried about the fiscal deficit, 7%. That's clearly not sustainable. They will ask for higher risk premium in looking at the holdings of Treasury. And it also, it crowds out other government functions. So the US now spends most of its money, if you look at single components, on servicing its debt. That means there's less money for other government roles. And that definitely will also be a drag on growth longer term. Yeah.
Well, listen, I'm going to turn to Puneet because we want to also know about what do these higher rates that you imply mean for corporate credit and markets more generally. And we'll come on to other regions as well. But let's turn to Puneet next. So Puneet, listening to what Tom and Charlotte said about the world environment, slower growth, yes, rates coming down in other parts of the world, in the US too, from what Tom said, but still a bit slower than you might like. We know the financial markets, and particularly the corporate credit markets, also thinking about commercial real estate, they're so tied in to interest rates and the risk of default. What do you make of all of that? Is there a possibility that we could find that even if the economy is kind of limping along or doing okay in other parts of the world, could the credit markets themselves cause a real obstacle from that growth dynamic?
Well, I would think at this point, no. I would think that the credit markets are actually not the ones where the imbalance is the largest. This is actually perhaps the reason why there is so much demand for credit, that there's very low risk premiums on offer. But let's remember one thing. I mean, this seems to be a slow simmering problem of interest rates. Effectively, we've had 4 years. This is the fourth year running where we've had high interest rates. That impacts everyone, whether it is consumers or whether it is corporations, whether it is small businesses, which is the reason why we are seeing delinquencies at an elevated pace in asset-backed securities and auto loans, as well as other types of consumer loans. We also see elevated bankruptcy levels as well among smaller companies.
But isn't that just a cleansing? Isn't it a lot of these companies have survived on very low interest rates who, frankly, they shouldn't have survived? So aren't you almost pleased to see actually there's a Darwinian element here where higher rates are forcing the weakest out?
Well, you can argue to some degree, but I don't think that's the case in general. I think this is basically a problem of higher interest rates, which cleans out the weakest clearly. But many of these companies could have survived had interest rates been 2% lower. It's not necessary that their business models are always very bad. It's just that the access to funding for the weakest is more restricted. In fact, the latest first quarter lending standards from the Fed have become tighter again, which actually forebodes higher default rates. And I think it's all interlinked, because the level of higher delinquencies, higher bankruptcies cause banks to actually lend less, which is then reflected in the lending standards. I think I'm not worried about the banking system as such from a systemic perspective. This is not 2008 or even 2023. Those problems are unlikely because central banks and other policy institutions remain behind them.
But you imply that the banks might be less willing to lend. So
Yes.
that's a break on economic activity.
Yes, indeed. It is. And I think that is what will happen. From a credit creation perspective, banks will remain more and more reluctant, because I think interest rates are higher and not everybody can afford the same mortgage, for example, that they could afford, or same consumer loan or same corporate loan. So that's why banks will be more restrictive, I think, which should act as a drag for.
Puni, one thing that, of course, has been discussed recently, of course, is the regulation around banks, and there's an easing taking place. I mean, how do you interpret that? Will that offset some of these concerns that you have?
I think the main offset will be more in the treasury market, where some of the regulations which are being eased actually around the leverage ratio and so on and so forth will allow banks to do better disintermediation as primary dealers in the treasury markets. From a longer term health perspective, I think reducing and some of this deregulation is negative in my opinion, because for creditors, you would actually be happier if the banks have stronger balance sheets rather than weaker balance sheets. I think banks will return more and more capital to shareholders at the cost of creditors. And so, to me, in the short term, this is positive for markets, positive for investors who are investing in these institutions. In the long term, from a systemic health perspective, from a stability perspective, even from a creditor perspective, I don't consider that to be necessarily a positive.
Now, we'll be speaking a lot in the next podcast about the markets and spreads more generally. But I guess what you're saying is that there are concerns. Bankruptcies are running at a reasonably high level for smaller companies, but you don't see that morphing into something worse. You don't see the bigger companies getting into trouble. And more importantly, it doesn't sound like, although there's risks out there, you don't see that part of the financial markets pulling down economies towards recession.
Not at the moment. And I think the composition of the defaults and the bankruptcies within themselves has been unusual over the last 3 years, where small companies have been defaulting and large companies have been better off. This is changing at the margin, and we do see some evidence and some recent examples. We are not necessarily reading too much into it, but we think that if this trend changes without even a pickup in aggregate default rates, that's quite negative for credit markets.
So let's keep an eye on that, and we'll, as I say, we'll come back to the market implications. But I want to turn to you, Ross, because you must be very happy covering Europe, and it's not often you say that to an economist or strategist who covers Europe. But tell me, my feeling is that President Trump should be given a big bear hug by all Europe. Because it sounds like actually Europe They knew what to do, or they knew what they needed to be done, and Draghi made it very clear in his reports. But President Trump has forced Europe to step up, and more importantly, they're forced Germany to spend money. What am I missing?
No, I think that's an
Just say
optimistic
yes.
but fair, in some respects, interpretation. But I will caveat one small bit of that. In the shorter term,
you had to bring a negative element into this, didn't you?
There are still some risks, specifically around what we were just talking about before with Tom and Charlotte around the tariff policy as well. So it's not all positive.
But I should say to our viewers, by the way, that Ross has put out a very good topical going into a great deal of detail about Germany in particular. But maybe just summarising a little bit, it is broadly good news. There's big numbers being spent.
It is. And as you say, look, this doesn't come lightly. Especially if you're an economist or an investor following Europe, it has paid to be fairly pessimistic on the growth outlook over the last many years, because the realised growth outlook has been very underwhelming. Germany, for example, has not grown in real terms really since 2018. There have been some positive stories within Europe, Spain, for example, but the whole euro area has really significantly underperformed the US. As you said, look, we were kind of aware of that. The Draghi report talks about the untenable nature of that. Something fundamentally needs to be done about that. And to the point to your question, we do see genuine reasons for optimism about that in the, let's say, medium to longer term. So we have big fiscal policy changes coming through. Germany has for years run, effectively very conservative fiscal policy, often for ideological reasons. They have an extremely strong balance sheet from a government perspective, and they are now using that. There is more broadly, at a European level, commitment for additional fiscal stimulus, primarily, yes, coming from the defence side of things. There's cooperation around that, though, which has the potential, not guaranteed,
the potential word again.
has the potential to be extremely positive, particularly if it's all research and development and so on. So that's one real positive.
But one thing I would say, the potential I feel a little better about is that Germany has brought forward or front-loaded some of their next budget. Is that proof that this time it's really different?
I think we have seen genuine good news on that front. There has been a surprise relative to, let's just say, broad market expectations, because the history of German fiscal policy is that it tends to, in a sense, overpromise and underdeliver, insofar as the projects that are identified are maybe a little bit or require less cash than expected. There's underspending generally. We're at the point now, and that was factored into most people's assumptions, that it would really be 26, 27 when we really see the big ramp up in spending. If you look at the budget that just came out last week, after we're recording it right now, at the beginning of July, there was a really significant intention there already to raise the cash for that. Again, though, that is still potential versus actual reality. We don't know, for example, a lot of this is pre-funding. However, it's really genuinely good news, I think, on that front. So the German fiscal policy, their single largest, most positive driver and big change relative to last year.
Where I get stuck is, yes, I can see how the big numbers work. Lots of zeros, 1 trillion of spending is a lot of money. But that's for Germany. What does that mean for the rest of the Eurozone, the EU? Do you see a lot of spillover? Does this catalyse them to do other things? Because they're much more constrained in terms of the debt load that they have.
So I see two things. The first one, I do see reason to believe there will be spillover with respect to this funding. So idea generally that an increase in aggregate demand within Germany, in the consumer area, in the business investment area, and business activity generally, should have a natural spillover to some degree to business activity within Europe outside of Germany. German consumers spending more on that, businesses investing more in the common single market. Do not get me wrong, Germany is clearly going to be the biggest beneficiary of specifically that German fiscal spending. But I think there are real reasons to believe that it will have positive implications through procurement of non-German funds bidding for some of this activity, and generally the idea that consumption activity will be higher overall in Germany. There is the second point, which is there is also some fiscal stimulus going on more broadly for the defence piece as well. There have been exemptions given to nations within Europe that allow them to basically exempt defence spending. Now, we could talk about markets. Not all of them are going to fully use that because they realise there are market forces that act on them, but they have that ability there. They have these big commitments from NATO, 5%. Yes, it's really 3.5 plus 1.5 on infrastructure. That particular piece is very, very positive, I think, for growth. And then, of course, you just have the safe mechanisms, so 150 billion joint European funding that's available for every country. Likely, will be used by more than others who are more constrained than Germany. So I think
let's hope so, because look, this is the window of opportunity for Europe. But listen, let's go back to the here and now. Are your numbers for the remainder of this year in Europe going up or down?
Down.
And will interest rates in Europe go down further than the market's expecting? I think the market's probably pricing in one more. Is that your base case?
The market is currently pricing in about 50% chance of a rate cut by September. I think, given the data that we're seeing and what I'm expecting, that rate cut will be delivered. I think the data, as was for the latter half of this year, the second half of this year, will come in generally weak. I think we had a lot of front loading with respect to this US tariff activity. Pre-buying, exactly. And I think more broadly, when I look at a range of indicators, there's reason to suspect that, uncertainty is still very high. The tariffs will have an impact, even though, yes, Europe may be impacted 10, 20%, not China 145%. Still, these are numbers, if you look back to a year before, were really, really potentially negative. And I think they will be. So light at the end of the tunnel, but I think there will be a bit of a weaker period in the immediate future.
So a little bit lower growth into the year end. Prospects 26 and 27 looking better. Inflation coming down. That should allow the ECB then to cut rates. Easy peasy.
So I think again, this is in look. We have some genuinely good news coming out of you with respect to the inflation front. So the ECB, I think, will cut rates further. However, I do not think we are going back to the world we were in previously. The rate ranges that we are in now, 2%, this estimate of where they have is neutral. Yes, I think they're going to go a little bit below that. But I think we're seeing, even just, for example, in the volatility of oil prices, ECB are concerned about that. There is this two-sided risk in the longer term. And I think a lot of the big fiscal, the big investments coming through will kind of keep a level that will keep ECB rates higher than they were previously. But, so like I said, growth is going to be kind of weak in the near term. I think the pressure will be there on inflation to also be a bit lower in the near term as well.
One thing we haven't spoken about, the T word for Europe, tariffs. Will we be surprised positively or negatively on the 9th of July?
So I guess it depends on how sunny your disposition is beforehand, whether you'll be surprised positively or negatively. I suspect the market will be negatively surprised by the numbers that come out. And I say that primarily because what is being mooted right now is Europe is willing to accept the 10% minimum level, which I think is a realistic level to kind of aim for. However, and we haven't talked about the UK, I know Tom covers that, the UK doesn't really have a trade deficit with the US, and certainly doesn't feature...
It's still about 9.3% tariffs on average.
Exactly. So my simple point there is, because, as we talked about previously, Trump cares very deeply about these bilateral deficits. Europe features extremely highly there. I would find it very hard to believe that they will get a similar deal with countries that screen simplistically better on his metric of bilateral deficits.
Great. Well, thank you for that, Ross. Now, listen, we've heard some positives from Europe, actually a lot of positive from Europe, partly courtesy of President Trump. Now I want to find out about China. So, turning to you, Ha. I mean, you're smiling there. Is it as good a prospect for China as it is for Europe? We saw China match the US tit for tat, getting up to 145% tariffs. And then it seemed that the US kind of backed off a little bit. Why did the US back off? And why was it not China who came to the table in Washington offering all goods up?
Yeah, so I guess the first half of the year, the whole headlines about US and China trade, the tensions, after that the trade deals, and China take it very, in a way that slowly, because I think at the beginning, the US is somewhat underestimated the cards that China has to play. At the end of the day, we have the US as the biggest consumer in the global economy, and China is the biggest producer, and they need each other. And I think only when President Trump actually put 145% tariff on China, and they realized that Americans just buy a lot of consumers products from China, including electronics, including dolls. We're talking about that. And more than that, they're also from the supply side, rare earths is one of the areas that China almost have a global monopoly. So the latest trade agreement between US and China on a framework basis that they exchanging the relaxation of rare earth export control in exchange for electronics or chips export from the US just highlight the fact that the two countries, even though they are not in love, but definitely they are very dependent on each other.
I mean, this must really hurt because they're clearly not in love. And in fact, you can imagine now the conversations are going. I mean, it certainly sounds like they desperately want to separate, but they can't. I mean, that symbiotic relationship, they're joined at the hip. How long can this last? How long do you think it will be that the agreement between, rare earths and batteries versus high-end chips, before one of them says, thank you very much, we have enough high-end chips, or we have enough rare earths now to go our separate ways and have an unhappy decoupling, perhaps?
I would think it will take quite a bit of time, especially from the US side, because at the end of the day, if we cut off China completely from the world, I think China can cover quite a big part of the supply chain from A to Z, and it's kind of self-sufficient. Yeah. But the US still need materials, still need battery from China. And I think from rare earths, for example, rare earths is called rare earths, but it's not so rare. However, the difficult part of that is basically the whole process of producing this kind of materials, and China have a significant advantage of that. I think a lot of producers a lot of importers has stocked up rare earths in the last few years and can last for a couple of years. And I think to have a whole mining process going on, it can take, 5 years, longer 10 years, and take decades to develop such kind of supply chain. So I think even we will see the diversification outside of China from the production point of view, but the complete decoupling is quite unlikely.
But it sounds like actually there's a bit of an asymmetry here, because what you implied is going to be hard for the US to replace these rare earths from China. China seems to be going all out to really beef up its AI, its technology production. Of course, we saw the example with DeepSeek. President Xi is saying that they're in a race as fast as they can to develop these high-end chips, high-end applications. We know there's, 12 million graduates coming from China's universities every year. They have the talent. It looks like they may have the capital. They certainly have the will, given what's happening in the United States. So would you put China kind of a nose ahead here in terms of becoming more self-sufficient quicker, perhaps?
This will be a quite complex topic, I would say so, because definitely, even though China running ahead in some of the technologies, especially you see the evolutions of EVs, of solar panel from the energy side as well, and also the breakthrough of DeepSeek. But basically, from the chip point of view, China is still one generation behind the US, and that's why you see that the US is really intensifying the whole measures from blocking China to access to some of the equipment to produce this kind of chip. But this is all at the same time put a lot of pressures on China to develop its own supply chain. So far, they have not done that breakthrough yet. No. We don't know what is the future, but definitely I think the US is quite aware of that race. Simply China is just doubling down on its strength. In the last 2 decades, China is always a production hub. It's very good at the whole industrial complex, and that is basically doubling down on the strength that China currently has. But the future, let's see how it's gonna be.
Now you speak about the strength China has. Charlotte earlier implied that there's an inherent weakness in China. There's goods that are being dumped, goods prices are falling. We're seeing CPI, PPI, negative territory in China. So how's that domestic economy? We've spoken on podcasts in the past about the fact that China has real structural issues, particularly around the housing market. It did appear that things were beginning to stabilize there. How is that looking now?
I think it's one part that people quite disappointed is actually from the domestic front. Definitely, we still have a property market it's not a crisis. It has been stabilizing in the last couple of months, but in recent months, pricing is down again. So definitely there is not yet a floor from that front. And given the fact that Chinese households having a lot of their wealth stored in the property market, that is tightly linked to the whole consumer confidence, and without consumer confidence you don't see consumption, and weak demand and overcapacity definitely make deflation become quite troublesome, and I think it will continue. I mean, it's a very interesting kind of strategy coming from China, because in a way, for example, in the EV sectors they have so many companies producing cars.
Incredible,
and recently you have BYD cutting prices by up more than 30% for many models, so create such a hefty competition in China.
And they were already very competitive, and that's another 30%, and that's just domestic, for domestic purchases.
Yes, it's for domestic purchases. But in a way, the way the government looking at that is they need competitions to see who is the survivor after the whole competition, to kind of move the whole company to the supply chain. But in the short term, it creates so much waste and so much overcapacity in the world, and that at the same time put a lot of pressures on overseas, because a lot of countries, including Asia and Europe, people complaining about China dumping goods into the market.
Now that kind of survival of the fittest, we mentioned sort of Darwinian practices in the credit markets. Does that mean that President Xi has embraced financial markets and the allocation of capital that the private sector gives them? In other words, is he going to need the private sector to be driving the innovation, to be driving the tech companies, to be driving AI?
I would say yes, in a way, because definitely President Xi has met with the tech executives earlier this year, and that is highlight the realization that the state-owned companies of themselves cannot really lead the innovations. We need tech companies, we need innovations within the private sector. However, the whole economy is still very state-driven kind of business model, from the banks, from the many other industry, and even from the private sectors. They also under quite a bit of guidance from the government what sector they need to focus on. So I think big picture is still very state-driven, but on a small scale, especially on the tech and innovations, definitely private companies are much faster in terms of moving up and innovating.
And maybe for our audience here, so the remainder of this year for China, how realistic is their 5% target for growth? Doesn't sound like it's going to be easily achievable.
I mean, I revised the growth significantly after the first tariffs tension between US and China, and after that I revised up, because definitely exports still account for about 40% of growth in China. But 5% sounds like a bit of tough target to hit until the second half of the year. I think there might be a little bit of policy loosening from monetary policy point of view and some fiscal space for that. But hitting a 5% is still a hard job.
Well, listen, we're going to be coming back in the podcast on the markets about the potential that we may or may not see in the Chinese financial markets. But now I want to turn to the southern hemisphere with Gustavo, who's online. I hope you're there, Gustavo, in the chilly part of the world right now. We're sweltering in Europe. You're in Chile, so thank you for joining us today. But Gustavo, I mean, you're part of the world. We're speaking about the volatility, the uncertainty, the political gyrations that we're seeing. I mean, that's everyday occurrences for you, right? But tell me a little bit about how Latin America is impacted, first of all, by what Tom and Charlotte have been talking about in terms of the tariffs that we're seeing from the US. Obviously, Mexico was in the front line of that right at the beginning with the executive orders coming from President Trump. Let's start there. How do we see that? Is that settling down? I haven't heard too much, actually, in recent days about what's happening in terms of US-Mexico tariffs.
Yes. Well, overall for the region, I think that has been relatively immune. Of course, the exception is Mexico. One of the reasons is the key dependence on the U.S. trade. About 80% of exports from Mexico are headed to U.S. And as you mentioned, a lot of noise was heard in the first part, but it seems that it's kind of the shift of the U.S. in terms of trade policy has shifted to the rest of the world. So far, no advancements have been made in terms of renegotiating the USMCA trade agreement. However, it's expected to be resumed at least during the second part of the year, as is key essential, of course, for the Mexican economy, but also to the U.S. economy, given the high interlinked structure in terms of industrial production.
In terms of Brazil as well, because we've spoken about interest rates globally coming down by and large, and that's been a function of inflation coming down. If we look at an economy like Brazil, and we often use that as almost a leading indicator a few years back during the times of COVID, when we saw inflation picking up, coming down because of the move in rates. I mean, it is interesting that Brazil only a week or so ago hiked rates again to 15%. I mean, 15%, that sounds remarkable. They have clearly not wavered in their desire to get inflation back down to target. I mean, I guess that's the importance of having independent central banks. So where are we in this cycle? I mean, is this the end of an old cycle, the middle of a medium cycle? What cycle are we in Brazil?
Yeah, I totally agree on that. Well, I think the market overall was a little bit surprised that this drastic hike of the central bank. I think that they are paying the cost, that maybe they anticipated cut far in advance, that maybe the economy didn't need such much of the cutting we see over the last, since the 2023 and onwards. So it's like the central bank has to make a statement of the commitment towards inflation containment. I think right now, in terms of the cycle, I clearly think that we are on the terminal rate. Hitting 15% is a record high, 2 decades high, and a real contractive stance. Going forward, I think that by the end of the year, we can start to be seeing a little bit of a cap, as inflation expectation has drastically go down since the beginning of the year.
And Gustavo, where does Brazil fit with all this tariff talk that we're having? I mean, you can see them sitting somewhere in the middle, of course, between China and the United States. Are they net beneficiaries from what we're seeing in a kind of a roundabout way?
I think so. I think that the reason why Brazilian economy has been relatively immune is because, firstly, it's a relatively close economy. It's not so dependent on export. And in fact, if export are more reliant on destination towards China. So maybe overall, as no specific target retaliation in terms of tariff from the US to Brazil has been made, I think Brazil can emerge as a relative winner, perhaps more increasing their market share within the Chinese market, as it could be a shift in trade going from Brazil to China and replacing maybe US shipments to China in terms of agricultural exports.
And maybe just to kind of finish the tour de force of the region, Argentina, we've seen chainsaws wielded there as well in terms of the established political environment that we're in. Tell me what's going on there with Milei as well. Is there some real wins being had here? Is the population still behind them? How does the economy look given what we've been seeing? It's been pretty drastic, and we've seen a lot of shift, I guess, certainly on the inflation front.
Yeah, I totally agree on that, guy. I think that the shift that has been made by the Milei administration is clearly extraordinary in Argentina, at least within his history. A drastic fiscal adjustment, 5% of GDP spanning over just 12 months or so, and inflation coming down really drastically. I think May's CPI print hit the lowest in 5 years. Print and coming from way above 25% on a monthly basis to just 1.5%. So even though this implies a really adjustment on the economy, of course, a lot of pain for the population, still, this is the more remarkably of the Milei administration, retains a lot of popularity. This is a clear, important point that markets follows closely, because Argentina is facing key midterm election in October, and it's a key test for the Milei administration to regain governability going to the second part of his administration. So we've had to pay a close attention on that.
And how close run do you think it is? I've been asking people to stick their neck out because, of course, it's all recorded. So it was only fair I ask you, how do you think the election looks like? And we probably won't hold you to this one because who really knows? It's still a few months out yet.
Yes, I think that all odds point out that the Milei's party will have a good performance. I think all point out that the Peronist right now is facing there is no clear leader to make a strong opposition. And Milei, as I mentioned before, retains a lot of popularity in spite of this harsh adjustment that has been made towards the economy and on the population. So good odds for the Milei, but we'll see in October. But I'm confident that the Milei administration will be positive on that election.
Very good. And now just finally to round off on your new home, sitting there in sunny, or should I say chilly, sorry about the bad jokes here, but chilly also, in an election mode right now as well. Just a couple of words on Chile for the remainder of this year from an economic perspective.
Yes. Well, overall, the region is facing a busy political calendar. In terms of Chile, in November, Chile will face a presidential election. This is a key, of course, every election is important, but for Chile, is the possibility to regain to shift toward a more market-friendly administration. We are coming from a left-sided administration that haven't performed so good. So I think all odds, market expectation as well pointed out that could be made this shift, but we'll have to see going forward. We just have a primary election on the left coalition, the ruling coalition, and a little bit of a tail risk has emerged because the left representative is coming from the Communist Party. Turnout has been low, so I think the market has reacted even positively because the market has interpreted, and we also comply with that interpretation, is that the odds for the market-friendly, more the center-right or even right candidates have improved given this polarization toward the far-left candidate. But of course, every election is volatile. So even though odds is playing to the market-friendly gamble, I think volatility could emerge going onwards to the November election.
Great. Well, thank you, Gustavo, to run out our around the world quick trip. As always, thank you to all the team of experts. We've just covered the macroeconomic parts. As you can tell, so much to speak about. I mean, the first half of this year has been crazy in terms of some of the policies, the shifting policies, the situation on the geopolitical front. I mean, we haven't gone into the implications of war still raging in many parts of the world, the impact that's had initially on oil prices, although oil prices have continued to fall by and large. But this is a world, as we say, that is confused. We are living in a land of confusion. I don't suspect the second half is going to be much easier, but we've seen a few things that I think we can hang our hat on to determine where we're going. It is important that inflation is coming down. That is allowing these central banks to cut interest rates. We suspect we've probably seen the high in bond yields. That's important from what Puneet said, because it means that funding costs at the margin could well be getting a little bit better going forward. And importantly, because we've seen a move away from the worst of these tariffs, there's a clear desire not to have a recession in the United States, which means that lessens the chance of recessions globally. So a world where growth will be a bit slower, interest rates will also be a bit lower, inflation is likely to be at or around central bank targets in most cases, with the blip up in the United States because of tariffs, we suspect relatively short-lived. So remember, as always, you can read the full report. You can listen to all our webcasts on zurich.com/MSME. And I do hope you'll all listen into our second podcast for the year, which will be looking at the financial markets and how they're likely to fare between now and year end. Thank you all again for joining us today, and thank you to the MSME team for joining me. We'll see you again very soon.
Thank you.